Hi there, I'm Dean Heskin, President and CEO of Swiss America Trading. If you've just tuned into us for the first time, welcome. And if you're with us again, welcome back. I have with me my co-host, Chris Agelastos. Chris, how are you today?
Doing well, thank you.
The cool weather has finally made it to Arizona. Cool
Yep.
and rain, actually. We've had several days of rain, and now we've got cool weather. So starting to actually kind of feel like fall and holiday time, which, we're right around the corner from that. So that's good.
Yeah.
Well, again, for those of you who are brand new to our podcast, The Secret War on Cash, what we discuss and look at are some of the factors, influences, things of that nature that are affecting our economy domestically as well as global, as well as like what effect or impact that may have on you, on me, on any or all of us. So let's get right into it. This first one, Chris, man, well, how depressing was this to look at?
I know.
As we've been talking about the debt on several podcasts. I mean, it's been all over the news. We had the shutdown and whatnot, so it's all kind of relevant. The United States is in a lot of debt, and you hear that a lot. All of us, I believe, I'm 55 years of age. You've been hearing about the U.S. being in debt forever, so it's become just a very common thing. It's a yawner in the news. In fact, one of our guys in the company, Billy, who works with a lot of our marketing and things of that nature, when he first jumped on board with us, he was like all over the debt. I'm like, he's like, we got to talk about this. This debt is out of control, and now, the interest is growing by trillions of dollars a year. And I told him, I said, listen, I hear you and I agree, but like, people don't really care. It seems like it's just, again, it's a yawner. But when you look at this chart, and CC's put it up here, I mean, my gosh, Chris, this is like insane. So of the total global debt, the United States holds 34.5 trillion. Okay. In second place is China at 16.8%, which is 2.2 trillion. Is that right? No, they increased by nearly in 2025. So it's 18.7 trillion, 18 trillion. But 18.7 is not even half of what the United States is.
Yeah.
And then in third place, if we're giving away gold, silver, and bronze, Japan is at 8.9%. And then from there, I mean, it drops huge. Like the next closest, you have Japan at nearly 9%. The next closest to that is a third of that. And then so you look at that and you're like, holy smokes. Like, yeah, I do think that, I mean, I've always believed that our debt was a problem, but like, I really believe like this is a huge problem. Now, I have talked to people over the years who, and then we have to adjust this number for inflation in the same, but there was an old expression. If you owe the bank $1 million is what it used to be, the bank owns you. If the bank owes you $1 million, then you own the bank. So like, no, excuse me. If you owe the bank the $1 million, you own the bank because they're at your mercy. The other way around. If I said that wrong, I don't know. But anyway, hopefully you get the gist of it. But this being said, I believe, maybe there are those people who subscribe to this notion that we owe the world so much debt that we own them. And I guess that could potentially be true. The problem is it's true until it's not true. And at the end of the day, we are sitting on an abundance of debt. And then you start looking at some of these other countries, Chris, like Italy. Italy's a nice place to live. I'd say probably even a great place to live. Spain, Germany, France. And you're talking, and do they have their political things? Certainly, as do we. And like, you're talking their debt in terms of global debt is like Italy's 3.1, France 3.5, Spain 1.7. I mean, this just paints a clear picture to me that there really is an issue here.
Yeah. I mean, when you factor in that, their debt is less than the interest we pay on ours, that kind of shows you how big of an issue it is. And I love this visual they put up there And for those of you listening, I'd suggest going to the site or tuning into YouTube and looking at this chart. When you see that the U.S., our portion of the debt is over a third of the entire global amount of debt. And then when you, like you mentioned, take into account that add China and Japan to that, and now 60%, two-thirds essentially of the world debt is between those three nations. That's a big deal. And of course, we're also some of the largest economies. But the real challenge here is, I think the reason people are so desensitized and talking about the debt doesn't really grab their attention is because at this point it's never going to go away. It's like this problem that we've all just kind of accepted because it's such a big issue that there's really nothing we can do about it as far as making it go away. Could we make some positive changes and maybe slow the growth and things like that? Yes, but when you look at the increased stimulus that China is talking about right now, because they've got a struggling property and real estate sector. Japan continues high borrowing. I mean, they're proposing another 92 billion in stimulus, even though they already have these massive debt levels, and the same thing's happening throughout Europe, even though their debt load is so much lower. They're continuing to print and spend money and go into debt. So this problem isn't going to change. Unfortunately, I think it's only going to continue to fuel devaluation of all those currencies, but most so the U.S. dollar, and we're going to continue to see high inflation because no matter who's in office, they're not changing this fundamental problem.
No, not even a little bit. And again, for those of you tuning in, like Chris had mentioned, I would encourage you as well to go click on the link and look at the graph here yourself. I mean, Chris, some of these countries are in such little debt you can't even read what country it is.
That's right.
Those are where we should move.
That's a good, yeah, that's a good sign.
If you care about debt, yeah. Where do you live if you're concerned about debt? You live in the countries that you can't see their name. And there's some good ones in there too. I mean, it does expand a little bit underneath it where you can see,
Yeah.
see what they actually are. Okay, so to this point, let's go to our next article. CC's going to put up here. The gold price. Gold's role is expanding, and Wall Street can't ignore it. And the reason I tied this one in, Chris, to the first one is because part of what they're talking about here and why Wall Street is now looking at gold, it has to do with the fact that yes, we're global debt, what's been happening with the U.S. dollar, and this is what has traditionally, kind of fed our marketplace. It's kind of what has pushed or moved gold along. What I did find interesting in here, when I first started at Swiss America back in 1992, I had just come out of the investment banking business. And in the article, like, I don't know, maybe halfway down, give or take, in one of the paragraphs, they talk about how, well, actually, I'll read it here. Let's see, why they can no longer ignore gold. Central bank buying created a, quote, gold put. 8,200 tons since 2013, fiscal dominance, overwhelming monetary policy. Fed cuts to 3.75%, real yields collapsing. 0.95% of central banks are planning to increase gold reserves. The narrative shift is complete, and this is the part I want to get into. Gold was looked upon by Wall Street, and this was a literal term, a barbarous relic to essential portfolio insurance, meaning like they didn't really see it as, being, it was barbaric. It was a relic.
Yeah,
it was
irrelevant. Yeah.
Correct, as an investment. And that has shifted, huge. It's shifted because, yes, central banks have been buying gold. That's because you see institutions buying gold. All the BRICS nations are making that the backbone of their whole financial move or initiative. So this is where, again, looking at the global debt that is, especially in the United States case, is spiraling out of control. This is why individuals like you and I and people tuned in, investors all over, should be diversified into precious metals, correct?
Absolutely. And that's what people need to do is follow what are the institutions doing, right? Do as I say, not as I do. When you have 95% of the world's central banks stockpiling gold for safety and security because they know about inflation and devaluation and what's happening in all the nations with their currencies. Obviously, we talk most here about the U.S., but this is happening all over the world. That's why you have so much demand. So, and when you have J.P. Morgan, Goldman Sachs, Morgan Stanley, all saying, $4,000 to $5,000 gold this year. We're already in the low 4,000 range right now, so they're already talking 5,000 this coming year. That should tell you something, because you're right. In this industry, gold was always sort of it just wasn't relevant to most financial advisors and investment banks. They were saying, look, it's just going to sit there and collect dust. You need to put your money somewhere where it's going to work for you. And now that inflation is so high, so you go put your cash in a CD at the bank and maybe you get 3% or so. Well, that doesn't matter when inflation is double that or triple that. You're still going backwards. And so that's one of the reasons we've seen such large gains, with gold doubling in value over the last year or two, and blowing away the S&P. I mean, all the major indexes, gold has been outperforming them. If you look at the last 15 to 20 year averages. So all of these are reasons that people need to be paying attention and doing with their portfolio what these major institutions are doing with theirs.
100%. And it's funny, Chris, you mentioned, some of the target price ranges that these institutions, or analysts have talked about. And, the gym I work out at, and I'm sure it's the same with you when you go place. People know I'm in the gold business, and, constantly they come up, and now, everybody wants to talk about it, and it's understandable. Like, the market's been hot for a lot of years, et cetera. And you have to keep your earbuds in, otherwise you'll never get a workout in. You just have to pretend you can't hear anything. But it's interesting. One of the guys who frequently talks to me about it is, gold had pulled back to, it was over 4, it went back to like a little under 4, 39.50 or something like that. Mm-hmm. And he was like, Dino, you think gold's made its run now? Is it done? Is it going to pull itself back? And I'm like, listen, gold, even at today's price, most analysts didn't expect it to be here until mid next year, let alone like right now. And to answer your question, I don't know. Do you think the debt's going away? You think that there's a fix on the horizon for what's going on with the US dollar? So, to your point, Chris, like these target ranges have become, there has not been one that I can think of in the last two years plus we've been doing this podcast that they've missed it on the low side significantly. But I think Goldman's prediction for this year was to finish at 3,300. And
at the beginning of the year, that's what they were saying, right?
Yeah. So, and it's not, look, it's not that they did a bad job of it. It's just, this is a reflection of what's taking place in the world around us today. So, well, for those of you tuning in, by the way, I apologize if you're watching this podcast. My computer stand seems to be a little springy today, so if I made you dizzy when I touched my computer a few times, I do apologize for that. Thanks for tuning in, and again, if you're not subscribed, please do so. If you'd like to get some more information on gold, learn a little bit about the marketplace, you can do so. It's free information. You can contact our office at 1-800-289-2646. You can text us as well at 1-800-289-2646, or visit us online at www.swissamerica.com, and you'll see both the phone number as well as the website in the show description. So thanks for tuning in. Chris, thanks for all the information. Have a great rest of your day.
Take care.